Welcome to Heresy Financial. My name is Joseph Brown, and this is the channel where we talk about financial education, topics, news in a way that's considered heresy to the financial establishment. And today is no exception. We are going to be diving into the recent announcement by the Federal Reserve, how they are going to start expanding their balance sheet again, and what that means for you and me. Let's dive in. All right, guys, this is a very important turn of events in the course of things that happen with the Federal Reserve. So let's do a little bit of a history lesson here. So back when the dot-com bubble burst, you had the stock market start to fall drastically. The Federal Reserve at that point decided to stimulate the economy. And at that point, that was the first time when they started these stimulus efforts that the housing market did not decline during a recession in history. That was the first time this happened. And so, the reason for that is because the stimulus efforts went to kind of help out the stock market, but the easy money policies actually went into the housing market as well. And so what this did was it caused people to think, hey, housing prices always go up. Real estate values always go up. And so the American people had this false idea that even during recessions, the housing market only continues to grow. And so everybody thought real estate was the perfect investment. And so you started to have a lot of money pour into real estate. A lot of people start flipping houses even more and more. A lot of really reckless malinvestments. People pouring more money than they should have, than the economy had the ability to actually support into real estate. So that's a classic example of a bubble, when more money goes into a certain investment than the economy can actually support. And so at some point that has to reverse, and it has to correct itself because too much money went in, so it has to correct itself, and the free market system kind of would take care of that. But because of the government interference in this particular time frame here, the problem was severe, to the point where these massive banks, these massive institutions, were at risk of failing, and we had a couple that did fail. And the way that our system works is that it transfers risk from individual institutions, individual banks, to the system overall. And so I won't get into the mechanics of how that works, but basically, 100 years ago, if a bank failed, a bank failed. And that's it. Whoever invested in that bank might lose their money or might lose part of their money, but only that one bank failed. The Federal Reserve came in 1913 and said, no, we don't want single banks to fail, and so we're going to have the system pick up the slack on any individual weakness. And so what that did was it transferred risk from individual nodes of the system to the entire system itself. The only thing that does is it transfers risk. It doesn't eliminate risk, and so there's a kind of it's called moral hazard that develops in a system like that, because now individual nodes don't carry any risk for their individual actions, and so the risk-taking endeavors that the individual nodes will engage in will increase because there's no risk. They've got no skin in the game, if you want to use Nassim Taleb's words, and so what that does is it creates an entire system that's fragile, because all the individual nodes will be taking on excess levels of risk because they're not the ones individually at risk. That risk gets transferred to the system overall. And so you have this system then that's at risk because of all of the behaviors of the individuals. Instead of the individuals being at risk, the system is. And so the banking institution basically became a plumbing system for our economy. It never should have been like that, but it is at this point. And so in 2007, 2008, 2009, when you had all of these investments, these funds full of mortgages, well, those were bad investments. But all of the financial institutions were invested in these things, and so you had companies like Lehman Brothers and Bear Stearns and AIG start to fall and collapse because the only thing they had were these bad investments. Well, the Federal Reserve realized this, and they said, hey, we've, for the last, since the creation of the Federal Reserve, we have a system that's built to where individuals aren't at risk. It's the system. That means that when enough risk gets put into the system, the entire system is at risk of failure and collapse. and our economy would have ground to a halt, basically, because it never should have been like this, but our banking system is the plumbing system of our economy. That's not a good system, but it's the reality. And so if that collapses, then there's no mechanisms or mechanics or system in place for commerce. It all kind of relies on the banking system. And that's a bad thing, but it's the way it works. So the Federal Reserve stepped in and said, instead of letting all these bad investments stay where they're at, we're going to buy them because they're worthless, but we're going to buy them at the value that keeps them from plummeting. So imagine a stock that they're bankrupt and they go from $100 a share to $1 a share. The Federal Reserve would have stepped in that scenario if you're looking at it from the example of a stock and said, even though it's worth $1 per share, we're going to buy it at $100 per share. So they inflated the values so that all these financial institutions that were relying on these bad investments, now all of a sudden they're not bad investments anymore. So the Federal Reserve bought up all these bad investments. And they did that through the U.S. government. The U.S. government tried to, did a lot of extra spending to stimulate the economy. They did TARP, that's a Troubled Asset Relief Program, and just ramped up all of the spending to try and rescue the economy. Because the economy overall had put so much money into these bad investments that there was no more money left over. And so the government says, hey, let's step in and let's create money out of thin air. And so the Federal Reserve did this, financed all the government debt that increased spending, and took all that debt onto its balance sheet, started expanding its balance sheet basically by buying up all this debt, buying up all these bad investments. Well, they said this is temporary. They said this isn't going to continue forever. We are keeping interest rates low to stimulate credit. We're going to, basically allow the U.S. government to spend as much money as they want, go into further and further debt. We'll buy any excess treasuries on the market to keep those rates that low, and we'll continue this going until the economy is strong enough to recover on its own, and then we'll start to undo what we've done. This isn't permanent. We're not, expanding our balance sheet permanently. Our plan is to expand it right now. We're going to buy all this up, and then we're going to start unloading it. We're going to unload treasuries. We're going to unload all these bad assets and kind of bleed down our balance sheet after a while. We're going to stop, manipulating the economy basically with our artificial interest rates and, money printing and increasing the money supply. And so back around, let's see, this was before the election, so this must have been summer of 2016. They still hadn't started increasing interest rates. They were still on this path still, and the market was given a lot of signs it was about to turn over. Now, the election of Trump changed things, and this is not political. This is just the fact of how valuation happens in the stock market. When a company is all of a sudden their revenue is going to go up, their valuation will go up as well. So if a company is worth $100 per share, and then all of a sudden their revenue increases by 10%, well, then their value will be $110 per share, just basic economics. And so when Trump got elected, the expectations were, hey, taxes are going to go down. So immediately valuations of the entire stock market went up. So you had this kind of wealth effect, boom, kind of kick-started again because everybody was expecting these tax cuts. The other thing was the deregulation that they were expecting now that Trump was elected. If he did, make good on some of his campaign promises, then deregulation would make it easier for businesses to make money. And so you had this, the stock market started to take off again because, the investors started to think, hey, these things that Trump might do will probably be good for the economy. Well, long story short, the things that he's done, some of them have been good for the economy, but mostly what he's done is just continued what Obama did before him, and Bush did before him, and Clinton did before him, and it's just all the politicians, all they ever do is increase government spending, increase the national debt, and it's not a tax issue. Taxes actually, the tax revenue has gone up. And I've said this multiple times, tax revenue is up right now compared to where it was a couple years ago. Even with the tax percentage cuts, the revenue is up. Americans are paying more in taxes now than they used to. It's just a smaller percentage. And it's just the spending that's taken off, record amounts of spending. And so really nothing has changed in that regard. And so a lot of the growth that we've seen has actually just been fake growth. It's been from government spending. So I went on a little bit of a tangent there, getting back to the, what we're talking about here. Basically, in 2016, when all of the good things started to happen in the economy, when people started to realize, hey, the tax cuts might be good for business, deregulation, whatever, all that stuff might be good for the economy. Well, the Federal Reserve took their chance there, and they said, hey, now we can start to raise interest rates. And so they started to raise interest rates. Well, what most people did not realize was that that was basically impossible from the beginning. Because once you engage in the type of policy the Federal Reserve started when the Great Recession happened, you can't get yourself out of that. When you swallow a bomb, at some point it's going to explode. Just because you swallow it doesn't mean it goes away. And so, yes, they pulled it out of the economy for a while, but eventually it's going to, that rot is going to come out again. And so when they started tightening, they called it quantitative tightening. That was just raising interest rates, trying to shrink the money supply. They were doing that because they felt the economy could support it. Well, didn't get anywhere near normal rates by the end of 2018 when they had to do the Powell pause. They said, okay, well, the market clearly, the economy clearly cannot support us, getting back to normal any further. And that's true. They would have kind of gone over the edge that they were trying to avoid in the first place. And so they had to stop raising rates. Well, they probably would have never been able to raise rates if Hillary would have gotten elected, but Trump getting elected gave them the ability to kind of play, pretend like they could, but they didn't get anywhere near normal. And so then this year they started lowering rates again. And now when you're lowering rates, that's a sign that the economy can't handle things on its own. And so this whole thing about the greatest economy we've ever had, it's all a bunch of baloney, because you don't need stimulus if you have a strong economy. So we've had these rates being lowered on us to stimulate the economy, to make credit, to make money easier to come by. And we're seeing all these asset bubbles, start to pop. They've been growing. So we've seen real estate, we've seen stocks, we've seen these unicorns, these IPOs. I've talked about bubbles in a previous video. You can go take a look at how pretty much every, student loans, credit, everything, auto loans, they're all kind of, sourced from the Federal Reserve's easy money policy. So that brings us to last month. And last month we had some shocks in the repo market. And I talked in previous videos about why that is significant, because it communicates distrust. Now, it could be, I've done a lot more research on that in the last couple of weeks. And it's still something it's very opaque. Nobody's able to tell what actually caused it, and nobody will know. If it turns into something that is a catalyst for a big crash, then later on people will look into it and it'll come out what happened. If it's nothing, it's going to just get forgot about, right? So just like most things. So we never know which pin is actually going to prick the bubble overall and start this kind of snowball effect of the crash and the recession coming on. But that could be one of them. So we did have that happen. And so that was coincidentally right when the Federal Reserve had lowered interest rates last month. So a couple weeks ago, we started having a lot of really bad economic data come out. The manufacturing is showing that we're already in a recession, at least in manufacturing. Services, really bad, under expectations. That's probably going to follow manufacturing all around the world. The trade tensions, global tensions. We've got little isolated incidences of violence and war starting to break out in Saudi Arabia and in Hong Kong. So we have a lot of things starting to pop up that are, they're never really good for the economy overall. And so paradoxically, made a video about this too. Paradoxically, all of that bad news made the markets go up, because all of a sudden now the markets were saying, hey, well, because of all this bad stuff, the Federal Reserve is probably going to lower interest rates again. And so that's a stimulus to the economy. So we're expecting now that the Federal Reserve is going to do it. So it creates this reverse kind of weird effect where everything is so bad that we think the Federal Reserve is going to come in and save us, and so that makes the market go up, even though the fact that the Federal Reserve has to save you in the first place means it's bad, so the market shouldn't be going up from that. So what did we have recently now? The last couple of days, Federal Reserve came out and they said, we are now going to start expanding our balance sheet again. And they used the words like normalization of the balance sheet. Now, this isn't normal. Now, the Federal Reserve's balance sheet is still almost just as big as it was after they expanded it. They barely got rid of, they barely shrunk it at all during that brief couple of months where they were raising interest rates. And now they're talking about normalization of the balance sheet means increasing it. Well, that's not normal. You're going back to stimulus. So that's quantitative easing. That's what they did to kind of try and rescue the economy in the first place since the Great Recession. And the only reason they called it quantitative easing is because they didn't want to call it debt monetization. And debt monetization, if you don't know what that is, it's basically just printing money to finance government spending. And I'll get into that in a moment. But now they're not even calling it quantitative easing. They're saying we're not doing quantitative easing, we're expanding our balance sheet. And it's very different than quantitative easing. But they didn't say how it's different, because it's not different. It's the same thing. You're expanding the balance sheet. So expanding the balance sheet is the same thing as quantitative easing. It's the same thing as debt monetization, which is essentially printing money to finance government spending. Now, when you print money to finance government spending, that is the kind of the nail in the coffin, if you will, when it's something that can't be reversed, because the government will never really pull back on their spending. And so we're already at almost record low interest rates historically, and the rest of the world is at zero or negative, and so we're expecting in America that will happen soon as well, that we'll continue to have lowering interest rates. And so the Federal Reserve now is what they're doing by lowering their interest rates and expanding their balance sheet is financing government spending. And so when the government, they have their tax revenue, but they spend way more than they make in taxes. So to do that, they use debt. Their credit card, if you will, is the U.S. Treasuries. And so you and I can buy a treasury, which means we're loaning the government money and they're paying us back with interest. Well, right now interest rates are really low. But the bad thing would be is if interest rates went up. Why would interest rates go up? Interest rates would go up because the person you're loaning money to is a bad credit risk. They're not a worthy borrower. And so the rest of the world is starting to realize that this quantitative easing policy was never an emergency measure. And that was the reason why we had a rise in the value of the dollar after the crash, is because the rest of the world kind of was like, all right, America, if this is an emergency measure, we'll play along. We'll buy up all these dollars that you're printing, and we'll go along with you. But the rest of the world's starting to realize it was never an emergency procedure, and it's going to continue indefinitely. They can't reverse this. It's impossible now. And so the rest of the world has stopped buying treasuries, and they're starting to sell treasuries. So that's why the Federal Reserve has to come in and buy these treasuries, because everybody else is selling them. They're turning into the only buyer of treasuries. That means the Federal Reserve is now, it's slowly becoming, faster and faster though, the only entity that is loaning the US government money. And what that means is that is starting to directly cause inflation, because if another country buys US Treasury, that doesn't cause inflation for us. But if our own country prints money to finance the deficits, that's a direct cause of inflation, especially when you have all these treasuries from overseas coming home. And here's why. I've explained this in a couple of videos here, so if this sounds familiar, I apologize. When, let's say China sells a treasury. Who's the buyer? The Federal Reserve. How do they buy something? They print dollars. So now dollars get swapped for treasuries. Now, if China doesn't want a treasury, they definitely don't want dollars. So how do they get rid of dollars? Well, nobody wanted the treasury. The only person that wanted the treasury was the Federal Reserve. Definitely nobody's going to want a dollar. So they're not going to be able to exchange dollars for euros or dollars for the yen or dollars for other currencies. The only people that are going to accept dollars are Americans, the American taxpayer, because the American taxpayer is the only one by law who has to accept the US dollar as legal tender for goods and services. And so what that's going to do is the rest of the world is going to sell their treasuries, they're going to get their dollars, and with those dollars, they're going to buy goods and services from the American people and American businesses. Well, when all this buying rushes in for all these American products, what does that do? When a lot of people are trying to buy the same things, the prices of those things skyrocket. And so we are going to enter into a period of massive inflation, potentially hyperinflation, and also most likely stagflation. That means a massive amount of inflation without any growth, because we're entering into a recessionary period here. And so people are going to be losing jobs, getting their salaries cut at the same time as all these costs and prices are going to be skyrocketing. And so, the Federal Reserve has to do this, because if they don't, treasury prices will plummet. And when a bond price plummets, the interest rate skyrockets. So if they didn't step in to be the buyer, that would mean that interest rates skyrocket and the US government could no longer afford to finance all of their spending. And if they can't finance their spending, then that'll never happen. The Federal Reserve will always allow them to finance their spending. And they have to, because they couldn't afford it if they had to do it at the market rates. And they're basically bankrupt, is what I'm getting at. But the Federal Reserve is going to do this because they have to, and that is why we're going to have an inflationary recession. And any of these things happening could spark that. In fact, I think we're already in a recession, and it's probably just started in manufacturing. We're going to see it pop up its head in more and more industries and sectors soon here. But that's why it's significant that the Federal Reserve has announced they're expanding their balance sheets again, because this is the beginning and it's only going to get worse. And we're going to see this problem kind of explode, and their balance sheet is going to explode. It's already growing at record rates. And so stay tuned. I hope you enjoyed the content. If you did, please like and subscribe, help a small channel out, share it with your friends and family, because the more people that know about this, the more prepared we'll be, and the easier it'll be when this stuff starts getting bad. So thank you so much for watching. Like and subscribe, and you have a great day. Thank you so much for watching. I really hope you enjoyed the content. I try and put out as much content as I can, especially whenever there is something new happening in the market. Please like and subscribe. And if you want more, if you need a step-by-step plan in order to prepare for the coming financial crash, I did write a book. It is on Amazon. You can buy the Kindle version or the paperback. It's called Financial Heresy. You can also find it on my website at heresy.financial, but it's easiest if you just go to Amazon. You can again get the Kindle or the paperback. It's called Financial Heresy. Thank you so much again for watching. Please like and subscribe and share. You guys have a great day.